Wall Street Bets is a bit of a disaster. A lot of people losing a lot of money, right? Some people are making money, but it's the same thing with lottery tickets. Like the only reason people buy lottery tickets is because there's a chance of making a lot of money. Otherwise, nobody would do it. So the fact that some people make money is only incentive for everybody else to hop in, but does not necessarily mean it's a good idea, right? I think we universally agree that buying lottery tickets is pretty financially irresponsible unless you want to fund education. And at that point, I'd rather just buy a bunch of notebooks and start hurling it at kindergartners, because I think that'd be probably a little bit more efficient and definitely more fun. All I'm saying is that we have a golden opportunity in front of us. We have 10 million people that are posting their losses on the internet, everything that happened. So if we can look at that, we can learn how you lose money. And if we know how to lose money, we can do the opposite of that and hopefully make money. Fact check me on that one. I think that's right. So I say, let's dive in. You and I, let's go take a look and see what Wall Street Bets has been up to. I'm also using this video as an opportunity to show off how stupid people get a lot of attention. And attention doesn't necessarily mean that that person is correct. And that primarily relates to this first post. So this one's titled, "It's a Lot Worse Than You Think." And it's some very in-depth bear DD. Most people are just hiding from the truth. The market has literally been fucking shooting upwards like we've never seen before without any healthy correction. We've created so much money out of thin fucking air, it's ridiculous. The amount of money we've created in the past year relative to total circulating dollars is absurd. A little redundant. Not even a massive bear, but holy shit, you guys are like too naive to see beyond the next market open. Do you realize how stupid this is? This is a fucking bubble. By the way, this is how Michael Burry sounded when he was talking about the mortgage crisis. This is exactly, he posted on threads just like this and he sounded just as insane. This is a fucking bubble. When money starts to move out, you're not going to know what hit you because you're too busy looking at the next 5 minutes. It will happen, and when it does, most of you, not all, will have the rug pulled out from underneath you and fall right on your asses because you're too nearsighted, too with one O, and haven't read any history about any time prior to the year you dumbasses graduated high school. What's happening right now in the economy is your childhood wet dream of eating your cookies without finishing your broccoli. Everything comes with a price. What would be childhood obesity and a heart attack at 30 in one case is the equivalent to having the rug pulled out from under you and going broke in another. But hey, at least you're living the childhood dream for now. It's fucking coming. Could be tomorrow, could be another 6 months, but holy shit, it is coming. If you look at articles and forums and stuff around 2010, 2011, maybe even 2009, late 2009, you will find articles and threads and stuff of people saying that the stock market is going to crash and that's overvalued. People have been trying to call the top since the stock market has existed, and they will continue to try to do so until the end of time. And maybe at one point when this country finally dissolves for whatever reason, they'll be screaming, "Ha, I did it," but the dollar will be completely useless anyway by that point. So just because some guy gets a bunch of attention on Wall Street Bets saying that the end is near does not mean that the end is actually near. People have been saying that for over a decade. And this guy's entire DD is that the stock market is going up too quickly, and therefore the stock market has to correct. And the correction is going to be so huge it's going to wipe out tons of people. That's his entire DD. The line is too vertical for him. He doesn't like it. It makes him uncomfortable. And that's a trend among traders and investors alike, that it's kind of scary to get in the market because it's always breaching new highs constantly. Since that bottom of 2008 to now, it's constantly been in the news. SPY reaches new highs. Dow Jones Industrial Average reaches record highs. Of course, it's always pushing to record highs because the economy is constantly growing. So when you see those articles all the time and you're looking at the stock chart, looking at SPY or diamonds or the Qs, and you see that we are at a record high, it makes you uncomfortable to get in. But you have to realize that numbskulls like this are not correct, and the stock market will ultimately, in the long run, continue to push up. And this guy has no DD. And he's gotten tons of attention. How many updates has he got? He's got 8,000 updates, ton of awards. People love bear stuff. They love it. It just gets them all riled up because they feel like they're living the big short, except for they're wrong every single time. If you actually look, which I did, at the historical returns of the S&P 500 since the stock market's bottomed out after the 2008-2009 recession, you will find that we have about an average of a 16% annual return between then and now, including this huge run-up we've had since the Fed started injecting tons of money into our economy. 16%. When you look at recent, you go, oh my God, the stock market's up like 40% or whatever. But if you look at the historical average yearly return since buying at the best time possible, at the bottom of the Great Recession, it averages out to a 16% annual return, which is nothing crazy. So when you see people like this saying the line's going up too hard, don't listen to them. They have. This guy's probably been in the stock market for probably since GME. So what was that, a year? Not even 8 months? All right, that one was just for fun. Let's actually see how people are losing money and see what we can do to avoid that. This next one's titled, "My Life is Ruined. I'm officially bankrupt tomorrow. Lost $500K since June." He lost $500K, looks like entirely on American Airlines call options that expired in August of 2021. The largest holding was American Airlines calls that expired in the 20th of August, 2021 had a 22 strike. I took a look. It says his average cost is $1.33. So $133 per each of those call options, of which he bought 1,161. So I took a look at the historical options prices on Thinkorswim TD Ameritrade's platform, and that means that he would have purchased those options back in July, probably, roughly. Again, it's average cost, so you can't know exactly the prices of all of them, but on average, he bought them at a price of $1.33 in premium, which was the price of that option back in July. Back then, $22 for American Airlines was only slightly out of the money. Okay, so he bought a slightly out of the money option that expired in nearly 2 months. So what went wrong here? Let's do a little post-mortem on him. What's the problem with this trade? Well, a few things. Number one, out of the money options tend to be more risky. If you buy out of the money call options, you're going to have a higher break even. You're going to have a higher time decay as a percentage of the overall value of the option. So time decay is going to eat up your options pretty quickly. And he chose an expiration that wasn't super close. Like it wasn't literally today or next week. It was almost 2 months out, but that's not actually that long. It's pretty long for WallStreetBets, but it's not that long. So he bought a little bit out of the money, and his expiration was not very far out. As a result, that means he has a higher break even. He has less time to reach that break even. So he's putting the probabilities of this trade against him right off the bat. But that's not a big deal. Like if you're super bullish on American Airlines, you could do worse than buying an option that expires in 2 months and is only slightly, like 1 point out of the money. If you're really bullish, not a bad idea. If you had done that at the bottom of those March lows back when coronavirus tanked the stock market, you would have made a ton of money. So it's not necessarily a bad thing as long as you have a good reason to be bullish and you don't bet the farm. That was this guy's biggest mistake, is he put all of his money in American Airlines call options. Why? Why would you even do that? Why not spread it a little bit? Like you're like guaranteeing your failure if things go wrong. This guy looks back and he's like, why did I do that? And it's like, you have to think about that ahead of time. Like things can go wrong. They go wrong all the time in the stock market. You have to think, what am I going to do if this trade goes against me? How am I going to handle it emotionally and also financially? Like, am I going to be able to pay the bills? And you decide if it's worth it to you or not. But you have to consider that failure is a very distinct possibility, especially when you're buying out of the money. When you're buying out of the money, probabilities are against you. Higher theta as a percentage of the relative value of the option, a higher break even, and with a short expiration, less time to reach that break even. So if you're buying out of the money, you really, really have to be sure that if this money disappears, which it very well could, that you're going to be okay. And this guy did not think about that. He was only thinking about the possibility of success, and he just YOLO'd it all and burnt all his money away. So what could you do instead? Don't bet the farm. Put less money in the trade. Less money in the trade, so if it goes wrong, then you're not going to literally go long rope. Number two, don't buy out of the money. Most of the time, you shouldn't. Okay, even if you're really bullish, put the probabilities on your side. If you buy in the money, you're lowering your break even, which is the stock price that the stock has to reach in order for you to break even on your call option by expiration. And if that's really confusing to you, like if that sentence just blows your mind, you have no idea what I'm saying, here's a tutorial to options that you can watch. It's super in depth. You'll learn everything you need to know about options. So lower your break even by buying in the money. Don't bet the farm. And then lastly, extend the expiration. I almost exclusively buy leap options, which are options that expire in a year or more. So that really makes 2 months look like not that much time, and it really isn't. It goes by like that. And as soon as you hit 1 month, the rate at which your option decays in value increases exponentially. Theta, that Greek that decays the value of your option, increases exponentially between 30 and 45 days. So it stays relatively constant, and all of a sudden your option will start degrading really fast, especially if it's out of the money. So push that out. Push that expiration out. It's going to make it more expensive because there's more time value in that option. And if it's in the money, it's going to make it more expensive because you're going to have more intrinsic value in that option. But so what? Just don't bet the farm. He didn't have to buy 1,161 or whatever his options. He could have bought 1 or 2 and put them deep in the money and far out at expiration. And he probably would have ended up making money because American Airlines did ultimately go up to 22. Okay, it went above a strike, but it was too late. And it's probably going to continue up over the long term. So if you had more time in this option, in these options, you would probably end up making money. But when you put the deadline so close, who wants to? The only time people want a near-term deadline is when they want to risk all their money and lose it. They don't want it anywhere else in life. They don't want to do projects soon. They don't want to do their homework soon, chores, whatever. The only time they want to do it is when they want to lose money. How backwards is that? Doesn't make any sense. Push the deadline out. Push your option in the money. Okay. So on those 22 strike options, he lost $152,000, but he said he lost $500K since June. Now, he might have had different positions than just American Airlines because it doesn't add up to $500K, but all he's showing here is American Airlines. And the 22 strike was the best strike. It was the lowest call option strike he had, which means it had the lowest break even. That was the one on the first page. And on the second page, all the other options he have higher strikes, 23, 27, 28, 30. They start going up and up. And your break even starts rising really high. If you have a call option whose strike is 30, you are expecting that stock reaches above 30. You have to reach 30 and the stock has to go up as much as you paid for the option. So your break even is strike price 30 plus how much you paid for the option. That's where you break even by expiration. Before that, you might have some time value, so the break even might be lower, but at expiration, it's strike plus premium. So if you have a strike of 30 on a call option, I just spat on my microphone, you want that stock to go above 30 just to break even. And American Airlines is trading down at like 21 when he bought these options at the price of $1.33. So in this case, he wanted the stock to go up like 50% in under 2 months with those 30 strike call options. You're not putting the probabilities on your side. You're almost guaranteeing failure. And then when you fail, you look back and go, where did I go wrong? You know, doesn't make any sense. Buy in the money, push your expiration out. Next post, let's go. This one's on Baba. The title is Ruined My Financial Future. This is 99% of my savings and basically everything that me and my mini family own. I think he meant my family own. Need Baba back up to 243 to break even. Right now, Baba's around 163. So looking at his positions, he's down $302,000. Currently has $76,000 still in the trade with 88 call options. The break even is 243, so he has to reach 243 just to break even by expiration. Remember, before expiration, before time value decays, extrinsic value of your option, the time value of your option, your break even is going to be lower. But as you approach expiration, that break even starts creeping upwards until it hits your strike price plus the premium you paid. So in this case, his break even by expiration is 243. So where did he go wrong? His strike is 200. Okay, his average cost is $4,300 per option of those 88 options. Looking at the historical options prices on TD Ameritrade's Thinkorswim, that means that he bought those call options back in May of 2021, and they expire in January. So he bought them in May, they expire in January. That's quite a bit of time, like 7 months, 8 months. He also had a strike of 200, and at that point, Baba was trading around 215. So if he has a strike of 200, Baba's trading at 213 or whatever, he's in the money. So he bought in the money, slightly in the money, and the expiration was like 7-8 months out. Sounds pretty good, right? Honestly, not a bad trade idea. Alibaba was doing great and still is a great company. And honestly, I'm very bullish on Alibaba. So it wasn't necessarily a bad trade. So where was his mistake? Where did he go wrong? Well, again, people are getting greedy when they shouldn't. And they bet the farm on any one trade. Even if you buy deep in the money, as deep as you can, and even if you push the expiration as far out as you can on a fantastic company, things can still go wrong. There could be a 1% chance or less that things go wrong, but they could still go wrong. And you have to think, what am I going to do if things go wrong? Financially and emotionally, how am I going to hold up? Can I hold up? If so, good, go for the trade. If not, and if you're being honest with yourself, like I'm not going to be able to sleep at night, or I won't be able to pay my bills, or I'm letting my kids down, I'm pulling out of their college fund, whatever, then don't enter the trade. So this guy bet the farm. He wasn't thinking about the possibility of failure. He thought Baba's a great stock. You know, I'm finally just going to buy in the money for far out expiration, but still sneak a little WallStreetBets flavor in there and put all my money into it. And that was his biggest mistake. So if you can learn some things from all three of these, mostly the second two, but I guess all three, is one, if you're going to buy call options, buy in the money. If you can, why not? Because it's going to put things in your favor. It's going to lower your break even, lower theta, etc. Number two, push out your expiration. If you push out your expiration, you're going to have more time to reach that break even price, more time to be correct. If you put your deadline super close, you may not hit your break even and you may lose some money. If it's an out of the money option, you're going to lose all the money you put in the trade. If it's in the money option, you actually won't lose all the money you put in the trade unless it becomes out of the money. You might lose some by expiration, but not all. Another reason why out of the money suck is because you can lose everything you put into it. But within the money, it has intrinsic value, which stays there. It's what you can exercise it for, buying at the strike price and selling at the current trading price. If it's in the money, you buy at a lower price and sell at a higher price if you exercise, and that value is built into the price of the option, intrinsic value. Go watch the tutorial. In the money options will not decay to zero by expiration. They're going to have a tanky, thick, concrete layer of value that does not go away unless it becomes out of the money, which is why out of the money options suck. So it's another kind of like buffer and hedge against your position. So buy in the money to lower your break even and increase the probability of not losing all the money you put in the trade. Push out your expiration so you have more time to reach that break even. And lastly, and possibly most importantly, don't bet the farm. Don't put all your money in one trade. In fact, put like 10% or less. Maybe max 20%. I don't know. You put 50%. I don't care. Just don't put all your money in the trade. Don't put so much money in the trade that when you look back, you go, why did I do that? Like if things go wrong, you look back and think, that doesn't make any sense. I can't afford that. Why would I ever think that would ever happen? I lost all my money, man. Like don't end up in that position. So there's no strict rule on how much money you should put into any trade. Just think about what happens if that money disappears. especially if it's a more risky trade, like out of the money, shorter term expiration, and decide whether or not you would financially and emotionally be able to cope with that. I've learned that nothing is more important in life than stable emotions and good sleep. So if you want to ruin your life sweating all the time and being stressed out, do out of the money options and throw your entire life savings into it. Or even do in the money options that expire in 2 years, but put all your life savings into it. It's a good way to stress out for at least a good chunk of time. It's good to see you guys. It's been a minute. I'll catch you in the next one.